Owen, thanks so much for joining us. You are leading now what is the largest publicly traded office REIT in the country, so it's obviously a portfolio that everybody's watching. While data centers are the darling of real estate right now, I hate to say office feels kind of like it's still the devil. Where are we? I'm told we've hit bottom by many experts. Do you agree with that? And where are we in the recovery?
Yeah, Diana, well, first, thanks for having me this morning. I definitely think we hit bottom. I think we hit bottom in 2024, and there are lots of positive things that are going on for part, not all, of the office business. So, as I always say, our clients are businesses, and leasing is driven really by two things. What's the health of our client? Are they growing their earnings? And two, are they using their space? And both of those trends are positive right now. If you look at, our companies are generally big, so if you use S&P 500 earnings as a proxy, earnings are growing, estimated to be, 11 or 12% this year. And then all of the mandates that many of the companies are mandating their employees coming back to the office. Placer AI just did release their report showing more and more people are using their offices.
And I want to get to how they're using those offices in a minute. But first, office is really, as you say, a barometer of the economy,
yes,
is it not? So if the economy, we talk about concerns in the economy, we're seeing layoffs, we're seeing, what do you think that effect is going to be on office going forward? Because it's been in the real past couple of years that we've seen that return.
Yeah. Well, I think, again, I go back to the earnings growth. That's been positive. And then if you look at the leasing activity that we've been having lately, and it's up very significantly, year to date, over the last, relative to the last 5 years, all those things. So you have to look at the underlying companies. And, many of the leases we're doing today are with financial services firms. They're growing. Part of it is what's going on with AI, but a lot of it is their businesses are proliferating, and then all of the legal services that support that activity, those firms are growing. And then the other thing that's very important, particularly for our segment, is these leading companies want to get their people back in the office. And of course they can mandate that, but what they really want is they want their people to want to come back to the office. So that's why you're seeing this bifurcation in the office business between the quality buildings that are being leased by the leading companies and then the rest, which are not performing nearly as well as what we call premier workplace segment of the industry.
Now, you're a big believer in working from the office.
Oh,
but
yeah.
Of course you have to be because you're the office guy. But you are personally, even in previous lives when you weren't in the office sector, you believe in that. Why?
I think companies are more successful, they're more productive, they collaborate better. Young employees are better trained and mentored if they're working in the office. I think it's hard to have a strong corporate culture if you've got people spread out all over the country. And by the way, Diana, employers know this. My view is a remote work benefit is very much like compensation. It's something that companies may decide to provide their employees to retain them and to attract them, but it has a real cost to the company.
But if you're saying it's compensation, then isn't it saying that people don't want to be in the office? If I consider it compensation that I get to stay home 2 days a week, then I don't want to be in your offices.
I think there are some employees that, actually they don't. And I think there are also cohorts of employees that have a harder time coming to the office. So for example, if you're a young person, you just graduated from college, many of them, particularly the ones that come to New York and are interns at these various firms, they want to come to the office and learn. And actually they want their bosses to be in there with them.
Is that a bigger problem, getting the bosses back?
Well, I think professionals that are kind of in the middle of their lives, they've got younger kids at home, more complexity, there are more demands on their time. I think what our clients are seeing is that's the cohort that they have the hardest time getting back to the offices. And then you get to leadership, generally people are a little bit older, maybe they're empty nesters, they want to set an example for everybody else.
And they just need somewhere to go,
and,
right?
Yeah, need somewhere to go. Or maybe culturally, like myself, they're used to working in the office throughout their careers.
So how are you changing the way you develop these office buildings and what types of buildings you want to invest in? You talk about Class A, that's the one that's leased up the most. We look at some of these trophy buildings, the new JP Morgan building that just opened in Manhattan. You've got a big new building opening in Manhattan. What is it that workers want in these buildings that they might not have gotten 10, 15 years ago?
So First thing that's very important, I just want to mention, this premier workplace segment, it's defined as, say, the top 10% of buildings. The performance of those buildings is way different from the rest of the market. The vacancy rate's 11% in the cities where we operate, which is 5 percentage points lower, and the asking rents are 55% higher. That's a huge delta. So what are these buildings? Well, new is great, but all premier buildings are not necessarily new. I can give you some examples of that. The first amenity, it's kind of old world, but it's very true today. Easy access to commuting, because again, what is remote work? It's, everyone complains, is the commute worth it? Well, if the commute is easier, then the commute is more likely to be worth it. So that's why we're so excited about this 343 Madison development we're doing, because it's got an escalator that goes into the Madison Concourse
and here
Grand
in
Central
DC,
Terminal.
You're putting one right over Metro
Yeah,
Center,
725 12th Street. We're building for 2 premier law firms, and it's right on top of Metro Center, which is the leading transit hub in Washington. So that's clearly an important amenity. And then I think meeting space. So why meeting space? Well, over time, companies in the past would say, well, I need a boardroom, I'm going to build one, and I'm going to lease it 365 days a year. Or I want to have an all-hands meeting, so I need a conference room that holds, whatever, 100 people. Well, today, what we're doing in our major facilities is we're providing those as amenities. So now, a client can just build smaller workplaces, living room, collaboration space, and then if they need a boardroom or they need a large meeting space, they can just rent it from us by the day as opposed to renting it all year. So I think that's important. And then I think food, depending on where the building is, grab-and-go food, affordable food, healthy and delicious food is very important. And then in some locations, a health benefit, a gymnasium or something like that's important. So, and then, other things, view, light and air, glass line. We like to have buildings that have, views all around, at least of a street view or a long view. That's also important.
Are we still doing that over-the-top stuff that we saw brought on by the tech generation, which was, you had to have a dog park in the area, you had to have ping pong tables and hammocks and, coffee bars on every floor. Is that still that? Or?
I think that it's probably pulled back a little bit, but don't forget, so we're the real estate, we're the office building developer and owner. So we build the building.
You don't put the stuff in it.
We don't put the stuff in it. So that's
but that's
the tenant.
What people want.
That's what they want. But we do, like at 343 Madison, we've dedicated the top 2 floors of that building to an amenity center. So there's, as I just said earlier, there's food options, there's meeting space, there's a bar, kind of lounge area, there's outdoor space. So the way we say it is every client in that building can be on the top floor because they have access to it.
And that's what we saw in Amazon's HQ too. Again, I think we walked around a dog park that was on the 8th floor. They even had a small garden in one area so people could have their farm to table while at work. Got to have it. So that's the luxury. That's the high end. That's what you call, is well leased, well valued. What about the rest of the market?
The rest of the market is much tougher. It's much tougher. So, and it depends a little bit on where you are. Like in New York, particularly if you're near transit, some of the buildings that are not in that premier workplace category are doing just fine because New York's hot. The Midtown vacancy rate is sub 10%. So buildings that don't have that premier quality are leasing up well. But if you're in a softer market that's 25+% vacant, the B buildings are very, very much struggling in this environment.
So what happens to all that?
Well, I think a variety of things. There's no one answer. So the first answer is, and the most important answer is, I described earlier what we're trying to do and what we are doing in our business, which is having the premier assets focused on the premium and the leading companies in all their sectors. But there's a more value-conscious segment of the office market, smaller firms, not leading firms. They can't afford or don't necessarily want to pay the rents that are required in these premier workplaces. So there are many office landlords today that have a strategy of, we're not trying to be the premier workplace provider, we're trying to be the best B building provider. So they're fixing up their buildings, they're providing some of these amenities that I described earlier, and they're providing a more value-oriented price point. So I think a lot of the demand will go to that. And then, look, the office market overall is overbuilt. there are going to be buildings that are demolished and made into something else.
And you're doing that, right?
We're doing some of it in suburban locations, nothing in our urban locations, but we do have a small number of suburban buildings that we are re-entitling the sites for residential and either converting the building to residential or tearing down a building and doing for sale attached housing. So, but the conversion, you know, when people get onto this topic, they think this is going to be the answer, and it's going to be an answer. It's not the answer.
Because not every building can be converted.
It can be converted, and then in places like New York, so New York's 400 million square feet of office. The amount of conversions that are going on today are about 15 million, which is, you know, not insignificant. And New York is probably the best market for conversions in the country because why? One, rents are so high, so the deals, you know, work from a financial standpoint. And second, I think very astutely, the city and state put in a tax incentive where if you convert an office building to residential, you get a tax benefit for, I think it's 30 years. So that also incents conversions. And that's, frankly, a huge thing that New York needs today is more housing, and I think it's an excellent program.
So you bring up New York City.
Yes.
What does it look like under the Mamdani administration?
Yeah. Well, I'm hopeful for a constructive outcome. I think, obviously, Mr. Mamdani is mayor, and we want him to be successful. I always say at BXP that our success in any one community is capped at our community's success. So if the city's not successful, we can't be either. And so, you know, we want to do what we can to help him figure out some of the things that he promised as a candidate, which is to get housing costs down. I think that's all about supply. We at BXP would love to have the housing supply, or excuse me, to have housing costs come down and try to help him and the administration figure out ways to promote more supply in New York City.
But there's this big cry that it's not just getting new development up, which would be great, getting more supply in, but really what he's going to do is, you know, rent control, freeze rents, lower rents, and people are going to go running from the city because they don't want to have higher taxes or they don't want to have, you know, some of the things that he wants to implement. And if people do go screaming from the city, that's going to hit your portfolio.
Yeah. Well, a couple things to step back. You raised a lot of different topics there. So first of all, the state of New York has a lot of controls over many of the policies of New York, including, by the way, the whole transit system and also the ability to tax. And the state has been very clear about the fact that they're not going to approve higher taxes in New York. So I think the focus that we've had on the Mamdani administration is what's going to happen with public safety and what's going to happen with education, particularly the former, because that's very important to our clients. Our clients' employees, when they're coming to work and they're working in New York, they want to feel safe. And Mr. Mamdani has said that he's going to hire Jessica Tisch as the chief of police, and she's done I think by all measures, a very strong job under Mayor Adams, and I think that she would be an excellent choice, and I think that would provide a lot of comfort, certainly to the business community, to see her as the chief of police.
So in your view, you do not see his election as the collapse of the commercial real estate market in New York City?
Yeah, I'm not sitting here saying that I think it's necessarily going to be a positive, but I do think given the approval rights that the state has over many things and some of the early decisions I see him making, like reappointing the chief of police, I think some of those are making us feel more constructive about what this outcome might look like.
And potentially offset some of the negatives.
Yes, yeah. Again, I think there has been a lot of negative rhetoric around it. It's understandable because he has been promoting a very progressive agenda. But given those facts that I outlined, I would be more constructive.
Okay, so I want to get back to what you were talking about, the B buildings that, you know, some of the landlords are fixing them up for smaller businesses, but a company like BXP is not interested in B, right?
No, our investment strategy is we want to be the premier workplace provider to leading clients in the industry. So where we're investing our capital is in new development. You know, you mentioned earlier we just launched 343 Madison in New York. That's a $2 billion project. We just launched 725 12th here in Washington, D.C. That's about a $450 million project. So that's where we're investing our new capital. We do look at acquisitions, but first of all, there's very few buildings that we are seeing in the market that are of equivalent quality to not only the ones we're building, but we think our entire portfolio. And when we see those, the yields on those kinds of deals, they're 6.5%, and we're getting over 8 on the developments. Now, it takes 4 years to deliver the development. That's the trade-off. But then, when the development is delivered, we have a new building. Generally, it's leased long-term to credit tenants, and there's very little CapEx requirement in a new building.
So the returns come rolling in.
But it just takes longer for it to unfold.
So who is going to invest in this very critical and very large section? And that's where a lot of the concern in, CMBS delinquencies are, commercial mortgage-backed securities. Does that concern you in any way? I know you're on the high end, but just getting, you're an expert in the whole area.
Yeah.
How concerned are you about that middle of the market, that it's going to bring maybe some banks down, et cetera, with it?
I don't know about that. I mean, this has been written about for 3 or 4 years, the downfall of office, and it was going to bring down the banking system, and it hasn't. And, office is improving dramatically, maybe not across the board, but it is improving. So it's kind of hard to sit here today and say that that's going to happen, because it hasn't. And I think, again, the office buildings are going to resolve, as I mentioned earlier. Some are doing great. I think there's an opportunity to fix up some of the buildings and make them perform better than they are. And there's going to be some segment of the market that just gets demolished. And there will be developers and banks that'll lose money on those, but I'm not sure they're at a scale to lead to the economic Armageddon that you described. And then on the investment side, you're seeing a bifurcation as well. You've got players like us. Now, we've not been as active on the acquisition side, but you've got players that recognize the opportunity to invest in...
The bargain hunting.
Yeah, well, I'm saying it's bifurcated. You've got the lower cap rate, high-quality building investors, but then you've got players that are buying buildings at a fraction of replacement costs. They're not very well leased. A lot of this has been family office kind of investment. And those players are saying, look, this is, a great city, San Francisco, wherever, Boston, wherever it is, and they're saying, look, this is such a discount to replacement cost. This market is going to come back in some way, and I will create a great return when it does. Well,
let's talk location. You like Manhattan, obviously. Yes. You seem to like D.C. What else do you like? Because you said San Francisco, but...
Yeah, so, I think if you break down our portfolio, everybody wants to do it big picture by city, but you actually have to break it into submarkets. So what I mean by that is, our strongest submarket by far is Midtown Manhattan. It's under 8% vacant, I think, right now. We're building new buildings. That's pretty obvious. I would say our second strongest market is the Back Bay of Boston. We have the Prudential Center, 200 Clarendon. We have some wonderful assets there.
And that's finance-driven or healthcare or?
All of the above. Legal services. I'd say it's probably more legal and financial services than healthcare, but that's driving the demand. All our buildings are close to full, or if not full, in the Back Bay. And then I would go to Reston, Virginia, here in our area. We own Reston Town Center. It's a very unique asset. It's 95+% leased right now. And then I would probably come back to New York and say, okay, Midtown South, because
there is a whole other country out there.
Right. So there's there's a whole other segment, and we own a couple of buildings in Midtown South, and they've been slower to lease up, although right now that's improving markedly. But again, my point is these cities are large. They have different submarkets that perform differently. And then, as you referenced a minute ago, lagging is the West Coast. The vacancy rates in San Francisco are high. They're above 30%. Now, for the premier buildings, they're probably in the high teens. But for the whole market, it's probably in the mid-30s.
And AI is not helping that a little bit?
AI is helping a lot. So in San Francisco alone, first of all, 90% plus or minus of the venture capital investment in AI is going into the Bay Area. So that says a lot. And then if you look at the leasing in San Francisco, there's already been about 6 million square feet of new demand that's come from AI companies. And that's clearly helped the market. And because the vacancy used to be higher, it's dropped some. Now the AI companies so far have not been necessarily going into the premier buildings downtown. They've been, these companies are growing rapidly. They don't know how big they're going to be in the near term, and so they're generally taking subleases in other buildings on a short-term basis and not doing a lot of direct leasing. But it is demand. It's bringing the availability down. And it also shows how AI can actually create jobs and demand and not just take it away.
And they are very office friendly. I'm told that AI does not like remote work.
That's absolutely true. That's absolutely true. The AI companies are working in the office, I think, more than 5 days a week.
Probably.
Yeah.
So you talk about these deals that are happening, that you're doing, that you're developing. How much has deal making improved? Interest rates are coming down-ish. A little bit, slowly, not as quickly as had been expected. Yeah. Given that environment, how is the deal making from your perspective?
Yeah, I think that capital is slowly coming back into office real estate. It started on the debt side. There have been several, very large debt securitizations. We just finished one. These are single asset securitizations done on office buildings in New York. We just completed one on a project in Boston. And spreads are coming down for these deals, and kind of surprisingly to me, but
Why?
What's that?
Why is it surprising?
Well, no, the spreads coming down doesn't surprise me, but what I was about to say is surprisingly to me, the 10-year has come down. It was 4.25, 4.5. Now we're at about 4%. That's a little bit more of a surprise to me. The credit spreads coming in doesn't surprise me at all because more capital is coming into it. There's more appreciation by the market that certainly this high-end component of the office business performs well and can sustain the debts that are being put on these projects. I think you're also seeing more capital coming into the business on the equity side. If you look at the transaction volume, it's up 10 or 15% from last quarter, the third quarter versus the second quarter, and it's up like 60 or 70% from the third quarter a year ago. So you're seeing capital come in, and I think you're seeing capital come in on the public side too. Our share price has improved over the last 6 months, and I think you're seeing offices, quote, catching a bid.
And so where do you think that capital is really, what's driving it? Because we've seen so much of it go to data centers, as I said. Apartment was hot and heavy for a while, multifamily, and people were staying away from office. What do you think is telling investors now, whether it's debt or equity side, that this is the time to get back in?
Yeah, I think you just answered the question. These other sectors have gotten a little bit overstretched from a valuation standpoint. The cap rates that are going, I'm excited about the capital that's come into office, but the cap rates are still much higher than what you can get for an apartment building or for an industrial property. So I think investors are saying, well, look, these properties, everyone's been chasing them for 3 or 4 years. They've been bid up. Now here's office that's been completely out of favor, but yet there's this segment of the office business that's really performing well. And the pricing is big discount to replacement cost, very high yield. What am I missing? That could be an opportunity. So that's why I think you're seeing equity investors shift, some of them shifting to office. And that's why I think you see credit spreads coming in a little bit as well.
So your company is leaning into the high end. You've made that clear. That's where you want to live. That's what you love. But from a general perspective, just finally, I want to ask you, because you've been out there in this a long time, but you didn't start in real estate. You were an engineer. You started in finance. What makes a great real estate investor? What are the 3 key things that you need to understand in order to be successful in this sector?
In real estate?
In real estate.
Yeah, well, I think it's, I'd say it's 3 things. I think one, you have to understand the market dynamic. You have to say to yourself, who is my customer and are they going to be interested in my product in the future? Whatever that may be, an office, a retail, a hotel in this location. And people that really have made fortunes in real estate, they are ahead of the market on that. They see a location and it's out of favor, nobody's doing anything, but they say that could be great, and then they go there, and sure enough, they create something, and the demand comes. They saw something before everyone else. So I think that's key. I think the second is finance. Real estate is a capital-intensive business, and you need to have a good handle on finance. I mean, if you're a developer or private, it's really property finance. For us, since we're a public company, it's both property finance and corporate finance. But you have to understand that capital allocation, how you finance things. Our cost of capital is much higher than our G&A expense, for example. And then I think third is relationships. Real estate is still a people business. Knowing a lot of people, and then as an executive, being a strong leader of your people is very important.
Owen Thomas, thanks so much.
Thank you.